In what ways does increasing interest rates control inflation? It makes headlines when central banks increase interest rates. The bank has determined that continuing to raise interest rates is the only way they can try to reduce inflation. Rates will rise in the future. Increasing interest rates will raise borrowing costs. It may have an impact on the entire economy. It can erode consumer confidence, lead to a loss of jobs and reduced salaries, and bring down stock prices. Going too far too quickly can cause economies to enter a recession. What drives central banks to boost interest rates then? Let's start with the fundamentals. If you borrow money, you'll have to pay a little extra to make the lender happy. Since you have a good reputation and are a trustworthy person, they believe they can grant you the loan. You'll be happy to hear that. This is the interest rate. In order to avoid having to pay as much back when taking out a loan, you should aim for a low interest rate. On the other hand, if you want to save money, a high interest rate means you can make more money. Consider it a gift for keeping money in your account. However, the amount of your reward is determined by the circumstances. In the economy, there is no single interest rate. Thousands of banks set their own commercial rates. But all of this is controlled by the interest rate set by the central bank. A central bank functions similarly to a bank for banks. Banks, like you and your savings account, earn interest when they deposit money with a central bank. Reserves are assets held by commercial banks. So, that's comparable to their available cash. Commercial banks can deposit their excess reserves at the central bank as well as lend such reserves to one another at interest. They can earn interest by doing so. Ordinary people cannot access the interest rate on extra reserves, but it still affects them. That is the concept. To slow the rate at which prices grow for everyone, central banks hike interest rates. In just 4 weeks, they went from costing £1.29 to £1.39. The Fed, the Bank of England, and the European Central Bank are all attempting to achieve a target inflation rate of 2%. Their most effective tool for doing that is interest rates. Banks hike interest rates when inflation is deemed excessive. The change impacts the financial system and lowers the inflation rate. Here's how. When a central bank raises interest rates, commercial banks earn more on their reserves. Instead of lending out their money, they might profit more from storing it in a central bank. So, if they do lend money out, they'll hike their interest rates to make it worthwhile. The economy determines how that influences consumers. Think about mortgages. Many people in Finland and Australia have variable rate mortgages. Higher interest rates basically translate into less money available for other uses right away if you have a variable rate mortgage, where the interest rate you pay is based on the central bank's interest rate. Households will spend less if they have less cash. As a result, firms will be more cautious about boosting prices. This should reduce inflation. Fixed-rate mortgages are more common in other nations, such as America and Canada. The effects of an increase in interest rates are less noticeable to people with fixed rates, but they will still be felt indirectly. Mortgages will cost more if interest rates rise. House prices will start to drop if it is a problem for all new buyers. And as a result, everyone who owns a home will feel poorer and may spend less. Lower spending equals lower inflation. And it's not just shoppers who will tighten their belts. When interest rates rise, firms will find it more expensive to borrow and invest. That often signifies less economic activity. It might result in less jobs created. Fewer jobs and lower earnings may result in less money for households and a drop in consumer confidence. That equals less money spent. People are dealing with a fall in real wages, which means their money buys less. When interest rates rise, it tends to limit consumption, investment, and overall economic activity. Overall, this will make firms more hesitant to boost their prices, causing inflation to slow. It sounds simple enough, right? Calculating how far to go is tricky though. The Federal Reserve, America's central bank, permitted interest rates to soar to a staggering 19% in 1981. The move reduced inflation, but it caused broad economic damage. I regret to inform you that we are in the worst economic crisis since the Great Depression. Without seriously impairing economic activity, it is quite challenging to control inflation. In America, it's been more than 70 years since inflation fell below 5% without precipitating a recession. A little inflation is fine. It maintains the economy's steady pace. However, too much inflation is a problem. As a result of rising costs, businesses will have to pay their employees more. This could lead to an upward spiral of wages and prices. Retail inflation in India has risen to 7.8%. The combination of sluggish economic growth and high inflation poses severe challenges to the Indian economy in the future. Central bankers are quite concerned about inflation expectations. The notion is that if it can demonstrate that it is believable that it will always act to bring inflation back down to 2%, it may not need to raise and then cut interest rates in this seesaw fashion. Raising interest rates can severely slow an economy. The issue is that the brake pedal has a delay. The full impact of interest rate adjustments can take up to 2 years. Central banks understand this. Thus, they attempt to read the future when they set interest rates. But predicting the future is difficult. The issue is that the central bank cannot predict whether inflation will fall on its own. And even when central banks do get it right, a crash could still happen. Raising interest rates is still the primary technique used by central banks to control inflation, despite its drawbacks. Yes, central bankers would say, rising interest rates is painful. Slowing the economy is not fun, but it's worthwhile. Having low and consistent inflation will allow you to stop worrying about it in the long run. Thank you for your time. Don't forget to subscribe.